Jamaica, welcome to another program of Centrally Speaking.
The program that opens up the conversation around important matters of economics and finance, matters of national importance that have an impact on your life. I'm Sheena.
And I'm Anna. We are so happy you could join us once again, and welcome aboard to those of you who are joining for the very first time. We invite you to stay with us.
Okay, so we have a great show lined up for you because in today's program, we will once again chat with Dr. Wayne Robinson, Senior Deputy Governor of Bank of Jamaica.
Wayne will be giving Jamaica the latest economic health check.
Yeah, but before we hear from Wayne, we first want to hear from you in the streets. It's time for Street Check.
What makes the price of goods and service rise?
Demand and supply, or interest rates.
Honestly, I think that is because of the interest rate.
Wow, never ready for this. Hold on.
Supply, demands, and interest rates.
Foreign exchange rates, supply and demand. Yeah, basically.
There are many things that can make the prices rise. I would say, for example, interest rates rising, government policies that are put into place where people cannot trade in a certain way, countries not producing their own products, so having to import things in, so then them putting taxes on those imports, war.
Inflation and foreign exchange.
I think it would be interest rates and foreign exchange rates would affect the prices of goods and services.
Remember, so Jamaica is mostly we get goods, we import goods. We don't have a lot of goods that we do ourselves. So it depends on how much they have to pay for it from the people them, and then they bring it back to us, and that's how much we pay for it. That's what the tax go on it. Because remember that the manufacturers have to make the goods, the materials that they use, all of them something they factor in. So that is why it's going up, and that's why we're skyrocketing, because after COVID, trust me, goods and services are hard to find, so inflation will go skyrocket. And Jamaica is not the only place experiencing inflation, everybody.
So you're sneaking a little supply and demand right there.
Yes, I did. Yes, I did.
Thank you, guys. Always great to receive your responses from the streets.
Yeah. So now come with us as we attempt to demystify economic matters so that everyone can understand.
Our guest, Dr. Wayne Robinson, Senior Deputy Governor at Bank of Jamaica, will be giving us an economic health checkup. Dr. Wayne, welcome back to Centrally Speaking.
Thank you, Anna. Thank you, Sheena. It's always good to be with you guys.
Yeah, it's good to
Likewise.
see you. So, Wayne, you have told us on numerous occasions what inflation is, right? It's not that my head tough, maybe Anna's head is tough.
And it's not tough.
Not tough. So for our viewers and for our new viewers, remind us, what is inflation?
Yeah. You know, that's a good place to start, Sheena, because, you know, we have been saying that inflation is coming down. But then you're going to say to me, well, every week I go to the supermarket, my supermarket bill is going up. So how do I reconcile this? Well, inflation is nothing more than the rate of increase in the prices of goods and services that we buy.
Okay.
So when you hear starting every month, they put out the figure and they say, well, the annual inflation rate as at May, I'm just throwing out a figure,
right?
We say 2%. All that they're saying is that over the past 12 months, prices generally, or prices on average, would have risen by 2%.
Okay.
So when we say inflation is falling, we're not saying that prices are falling. All we're saying is that prices are going up at a much slower pace.
Okay.
Now, when prices are actually falling, we don't use the term inflation, we use the term deflation.
Okay.
But, you know, Anna, here's the thing. In any healthy, growing, dynamic economy, you're always going to have price increases. Because there's a lot of activities, people are being employed, people are earning, people are buying stuff. So you're always going to have some price increases. But we don't want the rate of price increases, or we don't want the rate of inflation to be such that it causes more poverty in the economy. It makes it hard for people to do business because they just don't know where prices are going to go, and just makes life difficult, particularly for the poor in the society. So that is why we say we want inflation to be low, stable,
and predictable.
Dr. Wayne, inflation in February was 6.2, coming down from 7.4 in January. So I'm going to ask you a two-part question. Number one, what influenced this 2% or 2 percentage points decrease? That's the first question. And the other question is, how will it likely to continue? What are the factors that would allow that deflation to continue?
What I can tell you is that since then, Statin has released the numbers for March, which showed that inflation fell further to 5.6%.
Okay.
Nice.
It then went on to release the numbers for April to show that inflation fell even further to 5.3%.
Okay.
So that's good news. So we're seeing where inflation has now come back into the target. Well, the general decline in inflation that we've been seeing reflects a number of factors. One, international commodity prices, those have been coming down. Remember when we had the shock a couple of years ago?
Right.
So those have been coming down. In addition, the bank, as you know, have taken very strong, decisive actions to also try to contain inflation, and in doing so to also contain or manage the volatility in the exchange rate. So a combination of these factors have led to inflation, this continued downward trend in inflation. Now you ask about the future. Right? Well, our baseline projections suggest that over the next couple of months, say May, June, perhaps July, inflation will probably tick back up and go back up a little bit outside of our target range. And this is because, for one, we're in the dry period. And so we have been seeing increases in agricultural prices, and we expect that to continue over the next couple of months. Also, we have been seeing some movement in oil prices, so that will translate to higher prices at the pump, or to pay for gasoline at the pumps, and also could impact electricity prices as well. So that will cause it to tip back up. But the good news is that after that, we're going to be seeing inflation coming back down into the target range. So generally speaking, that downward trend we expect to continue in inflation. It's not going to be a smooth landing. We're going to have a little bit bumps here and there. But certainly we expect that for the second half of this year, and for most of the second half of this year going into next year, inflation should be back in our target range. But of course, you know, in this environment, we also have to be mindful that there are a lot of variables. And so we also have to be thinking about the risk. There is the geopolitical risk, that could again impact supply chains, and it could impact commodity prices as well. And also with climate change. The weather conditions make it much more difficult in terms of agricultural production. So the movement in agricultural prices could be even greater than what we are expecting or what we're forecasting. So there are risks on both sides, but generally we expect that the moderation in inflation will continue.
You are a doctor.
So they say.
So they say. But not a medical doctor, you're a doctor of economics.
Doctor of economics.
All right. So pretend that Jamaica is your patient, right? Are we coming to you, Dr. Wayne, for a checkup? All right. How we looking? How we stay?
Okay, well, we just spoke about inflation, which is a very important gauge of the health of an economy. And we just indicated that that is on a downward path. But there are other indicators that we can look at. And, you know, when you just take an objective assessment of all the other indicators, one has to conclude that the macroeconomic fundamentals of the Jamaican economy remain positive and very encouraging. We can talk, for example, about the debt to GDP ratio. As at March, that fell to about 72% of GDP. And you can remember, Anna and Sheena, then when it was coming down from a high of almost 140%.
Right.
Very, very high, one of the
man.
highest debt ratios
Right.
in the world. And we expect that certainly by March next year, that ratio could actually fall a little bit below 70%. Yeah.
Wow.
And by all indications, the government is on track to meet its 60% debt to GDP ratio by March 2028. Now, this is important for two reasons. With the debt falling and the cost of debt servicing falling, what it means is that the government has more space in its fiscal envelope to engage and to undertake critical expenditures, critical spending on infrastructure and all those amenities that improves welfare, one, and that improves the ability of the economy to grow. The second reason why that's important is the government is borrowing less, so it's demanding less financial resources from the system. What it means, the flip side of that is that more financial resources are available in the system for the private sector, so that the private sector also can undertake the necessary investments that will lead to further growth. So this is why the reduction in debt is very important and a very important indicator about the health of the economy. Another thing we can look at, Sheena and Anna, is the strength or the level of Bank of Jamaica's foreign reserves. And that is now a little bit over $5 billion US dollars. And what that means is that Bank of Jamaica has more than adequate foreign reserves to help to cushion the economy in the event of a shock. So if we get another shock, God forbid, like COVID, I mean, we have the there'll be no shortage of foreign currency to help us, to tide us through such shocks. Now, this didn't just come overnight. It reflects largely in part the fact that when we look at what Jamaica earns from or exports of goods and services, as well as what we get from remittance. And when you match that against what we have to pay for imports, for stuff that we import from abroad, what we see is basically we have been able to generate enough foreign exchange. The economy is able to generate enough foreign exchange to meet its external requirements. So when we talk about the balance of payments and the current account and the balance of payments, which tracks all of these flows, what we have to pay out and what we get in, we see that over the past 2 years, the current account of the balance of payments is in surplus, which tells us that the country is able to earn enough foreign exchange to cover its external financing needs. So again, that's another positive sign for the economy. So when we put all of these things together, what we're looking is an economy that is on a very good track. The macroeconomic fundamentals are positive. We have a stable macroeconomy. So what is needed now is to build on that platform. Right? So we now need to start to focus on the things that can actually drive productivity, the things that can actually drive greater investments that will lead to greater employment and a better quality of life for us all.
Dr. Wayne Robinson, Senior Deputy Governor at the Bank of Jamaica, giving us an update on the health of the economy of Jamaica. And more to come on Centrally Speaking right after this break.
Welcome back to Centrally Speaking. Our guest today is Dr. Wayne Robinson, Senior Deputy Governor at Bank of Jamaica. Now, Dr. Wayne, before we went to the break, you were giving us our health report, in the capacity of, doctor of economics. So you're telling us that with pressure good and with blood sugar good. So I want to talk about the nervous system now, the financial sector, the commercial banks, the building societies, the credit unions. Are those good?
Well, Anna, in April, we published our financial stability report. And in that report, we give a comprehensive diagnosis of the financial sector, of the banks, your building societies, your securities dealers, your insurance companies, and so on. And the key message coming out of that analysis is that despite the fact that we have what is called a tight financial conditions, and that's because we are in an environment where interest rates are higher. Despite that, the financial system still remains sound.
Right.
Because, and why we say that? Well, when we look at their capital, we find that their capital is adequate. When we look at their liquidity, we find that that is adequate. So the banks and the financial institutions are able to service the needs of their customers.
Okay.
But moreover, when we contemplate scenarios of more extreme economic and financial conditions, we see that the financial sector also holds up well under those circumstances.
Okay.
So that gives us a level of comfort that the system is strong. But of course, you know, there are always risks because we're in a very dynamic environment. So what that means is that the regulators, Bank of Jamaica, the Financial Securities Commission, we have to remain vigilant and to monitor these risks and to monitor how the system is actually managing these risks.
So that's reassuring, Wayne. Now, we're going to jump now to monetary policy. I know you've told us about it before, time and time again, but please remind us, what is monetary policy?
So, Sheena, monetary policy really refers to the actions that a central bank takes to influence the level of interest rates in the economy, and in so doing to influence the volume of credit and the volume of money that is circulating in the economy. Now, a central bank will deploy what is called monetary policy tools to do this. So in Jamaica, Bank of Jamaica, we really use three main tools. The primary one is our policy rate, which is really the interest rate that we pay on commercial banks' current account deposits at the bank. And when we move this rate, what we're doing is that we're actually signaling to the banks as to where we want rates to go. We complement that by conducting what is called open market operations. So every week we're in the market and we are issuing and redeeming what is called certificates of deposits that the primary dealers that they invest in. And by doing so, we're able to manage the amount of liquidity that's in the financial system.
Okay.
The third tool that we use, but we don't use that very often, is what is called the cash reserve ratio.
Okay.
Now, what basically it is that we say to a bank, for every dollar of deposit that they take from the public, they have to hold a fraction of that with us.
Okay.
And guess what? We don't pay them any interest on it.
Okay.
Right. So again, that's another tool that helps us to manage the liquidity in the system.
All right, so you've explained monetary policy and given examples of the three tools that you use. But what do you try to achieve with the monetary policy interventions to date?
Our mandate is inflation.
Right.
That's the bank's primary mandate. Recall we have two mandates, price stability and financial system stability.
Right.
Yeah.
And price stability is the primary mandate,
Right.
Which basically means low, stable and predictable, inflation. And what that means is that the government sets us a target for inflation that we have to try to hit. We have to try to get inflation in that range and we have to keep it in that range. And that target is 4 to 6% in terms of the annual rate of inflation. So our job is to try to get inflation back into the 4 to 6% range, and we also have to try to keep it. And recently the Minister of Finance reaffirmed that target for us, and that target will be in place for the next 3 years.
Okay.
So for the next 3 years, our job is to try to keep inflation in the 4 to 6% range.
Okay. Now,
if you can recall, Sheena and Anna, when we were coming out of COVID, when the economies started to open up and people's demand started to surge, but the suppliers and the distributors, they weren't able to meet that surge in demand, prices shot up. And so the prices of commodities that we import went up. And then shortly after that, we had the Russian invasion of Ukraine. And you know that Ukraine is a major commodity exporter. So again, that was another shock to prices. And we have been grappling and managing that ever since. Now, so what we've had to do, when you ask about what is it we're trying to do, In that context, we had to try to focus on three things. One, because the shock to inflation was really external, it was really because of the goods and services we import.
Yeah.
The first thing we had to ensure is that the exchange rate doesn't run away. Because if the exchange rate runs away, then that immediately feeds into prices.
Right.
All right, so we have been trying to manage the volatility in the exchange rate. The second thing we've had to do is to try to manage demand or spending in the economy. Because if demand exceeds supply, prices are going to rise. In other words, if the more people wants to spend, the more there's strong demand in the economy, the easier it is to pass on price increases. So we have had to try to also manage demand. The third thing we also have been trying to do, is to manage people's expectations about inflation. Because believe it or not, Sheena and Anna, what people expect inflation to be is a major factor into actually what inflation turns out to be. Yeah, because just think of yourself as a worker. If you expect that prices are going to continue to rise, you're going to want to demand more wages, and that is rational. Right? That's what one would expect an irrational person to do. Right? So when an employer has to pay higher wages, he's going to pass that on to prices as well. But also when if a producer expects prices to continue to go up, so they expect their own costs to continue to go up, they're going to want to also set their prices to ensure that they can cover themselves. So there you see how people expect prices to move actually influence how prices actually move. So we also have to try to manage that. So you will note ever since we've started the tightening of monetary policy, the Monetary Policy Committee has adopted a three-pronged approach. One, we have raised our policy rate. We have been very proactive in the foreign exchange market, trying to dampen the volatility in the exchange rate. We've allowed the exchange rate to continue to move, but we have actually tried to manage how it moves so it doesn't exacerbate the inflation problem. And the third thing we've tried to do is to manage more tightly the liquidity that's in the system. And fourthly, you'll notice that we have been talking a lot more about inflation using programs like these. And we have been trying to explain a lot more about what we are doing and what we expect to happen.
Well, you mentioned the foreign exchange market, and I'm happy you did because it dovetails nicely into my question. From my perspective, the Jamaican dollar has been relatively stable. So tell me if this is correct. And also, what can we expect up to year end?
All right, you're correct. Certainly if you look over the past year or two, the exchange rate has been fluctuating between 154 and 158. So it has just been going up and down, up and down. So if you look at the average exchange rate, if you average it out over time, you see that the movement in the average exchange rate is between 1 and 2%. Right? So that's a pretty stable exchange rate. Of course, the exchange rate will continue to move. Why has this happened? Well, of course, as I mentioned, we have taken a more proactive approach in trying to manage the volatility in the exchange rate, but also with the recovery in tourism, with the strong remittance inflows, the flows into the foreign exchange market itself has been strong, which has helped to also maintain this stability in the market. Looking ahead, well, what I'll say is that we don't have a fixed exchange rate. What we have is a floating exchange rate. So the exchange rate is going to continue to move based on the demand and supply. And we will continue to ensure that the movement in the exchange rates isn't destabilizing, they don't cause panic, and they don't worsen the inflation problem.
So Dr. Wayne, you have told us that the exchange rate has been pretty stable, especially over the past year. If you were to sum up, our conversation, how would you do so in giving some reassurance to the Jamaican public?
We have made significant strides in reducing inflation, and that's very important for the Jamaican people. Now, the question that naturally arises is, well, when are you going to then start cutting interest rates, right? So, as the governor said in his last press briefing, we want to be very sure that inflation is now firmly anchored in the 4 to 6% target range.
Okay.
As I said, we are on that track, but over the next 2 months, we may have some amount of pressures that will cause it to tick back up, but it will certainly come back down. So we have to watch the incoming data to see what the incoming data is telling us. And once the Monetary Policy Committee is reassured that inflation is now firmly anchored, then we'll consider how we will pivot monetary policy. But all the indicators suggest that we are on a good track. The macro fundamentals of the economy, as I said, remains positive. And what it requires now is for us to build on this firm foundation.
Okay.
All right. And with that great news, we wrap up our riveting conversation with Dr. Wayne Robinson. Thank you so much, Wayne.
And thanks for being so candid.
Yes.
Okay. Thanks,
glad to
Sheena.
know that
Thanks,
we're in-
Anna. It's always a pleasure talking to you.
Yes.
Good to know that we're in the best of health.
We have more work to do, though.
Yes.
That's
Right.
important. We
Always.
have more work to do.
Always. We have been speaking with Dr. Wayne Robinson, Senior Deputy Governor, Bank of Jamaica. He has been giving us the perspective on the health of the Jamaican economy. Centrally speaking, we'll be right back after the break.
On today's episode, Dr. Wayne Robinson, Senior Deputy Governor at Bank of Jamaica, gave us a report on the health of Jamaica's economy. Here's a recap of the conversation. It's now time for Fast Facts. Number 1. In April, inflation was 5.3%, which is within BOJ's target range of 4% to 6%. Number 2. An important indicator for us at the central bank is core inflation, which is inflation excluding volatile commodities such as agriculture and energy. Number 3, BOJ's gross foreign reserves are at a historic high of US $5.2 billion as at March, which means that Jamaica is in a much better position to handle shocks. Number 4, the current account of Jamaica's balance of payments has been in surplus. And number 5, the financial sector remains sound and stable. This means banks have adequate capital and liquidity to meet the needs of their customers. And that's it for our Fast Facts. And that's our program for this week.
Follow us on X and Facebook at Central Bank JA, at Central Bank Jamaica on Instagram, and on BOJ's YouTube channel. You can also visit our website, boj.org.jm.
We also invite you to send in your questions on X or Facebook.
And of course, tune in again to Centrally Speaking next week at the same time, right here on your station, when we will have another special guest. Thanks for watching.
See you next week.
I'm Anna.
And I'm Sheena. Centrally Speaking is a production of Bank of Jamaica.